The market woke up with a hangover. A tariff hangover. Trump, in his infinite wisdom, had unleashed a new wave of tariffs. This time they were big, really big. The kind of tariffs that make economists shudder. The Dow Jones, that reliable barometer of American optimism, took a nosedive. It was a bloodbath. The financial news channels, usually a symphony of soothing market jargon, were now a cacophony of panic. Experts with faces contorted in disbelief tried to make sense of the carnage. The consensus? No one knew what the hell was going to happen, but it didn't look good. Let's talk numbers, people. The Dow Jones, that granddaddy of market indices, plunged almost 4%. 1,679 points vanished like tears in the rain. The S&P 500, home to America's corporate giants, wasn't spared either. It tanked 4.84%, and the Nasdaq? Don't even get me started. Tech darlings, once invincible, were brought down to earth with a thud. It was a massacre. The Russell 2000, a haven for small-cap companies, entered bear market territory. That's Wall Street jargon for we're officially screwed. Investors, those brave souls who bet on America's future, were running for the exits. Their safe haven? Cash. Lots and lots of cash. Tariffs, like a bad hurricane, leave a trail of destruction. Some sectors were hit harder than others. Banks, those pillars of financial stability, crumbled like sandcastles. The KBE Bank Index plunged nearly 8%. The KRE Regional Bank Index? Over 9%, ouch. Luxury retail, that playground for the 1%, felt the heat. Capri Holdings, the parent company of Michael Kors and Versace, saw its stock plummet by almost 25%. Tapestry, owner of Coach and Kate Spade, wasn't far behind, down over 15%. Even mighty LVMH, the French luxury conglomerate, took a 5.9% hit. The message was clear: when tariffs bite, even the rich bleed. Economists, those modern-day oracles, emerged from their data-filled caves with dire predictions. Fitch Ratings, a credit rating agency not known for hyperbole, estimated the effective tariff rate at a staggering 25%. That's the highest in over a century. UBS, a global financial services giant, painted an even grimmer picture. Their analysts predicted that if Trump's tariffs remained in place, inflation could skyrocket to 5%. GDP growth? Kiss it goodbye. They projected a hit of 1.5 to 2 percentage points. The American dream, it seemed, was on hold. The mood on Wall Street? Let's just say it wasn't pretty. Fear, like a contagious virus, spread through the trading floors. The AOAI Investor Sentiment Survey, a closely watched barometer of investor confidence, showed that bearish sentiment had reached a staggering 61.9%. That's the highest level since the dark days of the 2008 financial crisis. Volatility, that evil twin of uncertainty, reared its ugly head. The VIX, Wall Street's fear gauge, spiked to levels not seen in years. Investors, once eager to buy the dip, were now running for cover. The smart money, as they say, was on the sidelines, waiting for the dust to settle. Section 6. Global Sell-Off. The shockwaves from Trump's tariff tantrum were felt far beyond Wall Street. Markets across Asia and Europe tumbled in sync with their American counterparts. The Nikkei, Japan's benchmark index, plunged 2.77%. The Topix, another key Japanese index, fared even worse, down 3.08%. Europe wasn't spared either. The Stock 600, a broad index of European companies, fell 1.6%. The euro and the yen, seen as safe haven currencies, strengthened against the US dollar. The message was clear: when America sneezes, the world catches a cold. Section 7. Corporate Fallout. The fallout from Trump's tariff war wasn't limited to Wall Street and global markets. American businesses, caught in the crossfire, were forced to make tough choices. Microsoft, the tech behemoth, put several data center projects on hold, citing uncertainty over the impact of tariffs on its supply chain. Ford, the iconic American automaker, offered employee pricing to customers in an effort to offset the higher costs of imported parts. The move, while well-intentioned, was a stark reminder of the ripple effects of Trump's protectionist policies. Section 8. Experts sound the alarm. Analysts, those seasoned observers of the financial landscape, were quick to weigh in on the implications of Trump's tariff shock. Raymond James, a leading financial services firm, warned that the tariffs created a new level of uncertainty for businesses and investors alike. Reciprocal tariffs from China and other trading partners were a major concern. Mercer Advisors, a global investment consulting firm, echoed these concerns. They argued that the tariffs were inherently inflationary and would ultimately stifle economic growth. Global X, a provider of ETFs, warned that the tariffs would hinder the outperformance of international equities. Section 9. Trump versus reality. While the markets reeled and experts sounded the alarm, Trump remained defiant. In a series of tweets, he expressed confidence that the tariffs would ultimately benefit the American economy. He claimed that China would soon cry uncle and agree to a trade deal on his terms. He urged investors to stay the course, assuring them that the market turmoil was just a temporary blip. The disconnect between Trump's rhetoric and the market's reaction was stark. While the president remained bullish, investors were voting with their wallets, and their message was clear. They had no confidence in his ability to manage the economy. The tariff war, it seemed, had backfired, leaving a trail of casualties in its wake.